in past videos, we discussed purchasing long calls and long puts. But in this video, we're going to take it one step further and we're going to discuss purchasing long puts and actually spreading them out to adjust our overall assumption and our risk reward profile to actually benefit us while still participating in an underlying asset move, which we have with our overall, which aligns with our overall assumption. Now, we talked about purchasing puts and what that means. We means that we're bearish on the stock. We want the stock to go down, and we're purchasing things that we can exercise between now and the expiration date if we would like to either get long or short a stock. So if we're going to buy this 215 put right here, we're in the April monthlies here in Apple. We're going to purchase this. It's going to be at 815. Really, the mid price is at 805. So we're going to purchase this for all things being equal at 815. So that means the stock is going to go down. We have a max loss here of 815. Our max profit is capped because obviously Apple can only go from 213 to 0. It cannot go any lower than 0. So your call side, when you're purchasing calls, it's infinity, right? Because technically stocks can go until whenever, but stocks can only go so far down. They can only go to 0. So your max profit is capped down here. And that is if Apple goes to completely 0 by April 17th. That's what we will realize in our gains. You can see our probability of profit is at 38. Our delta is at minus 52. That is because we are going down, right? We want the stock to decrease in value. So delta is therefore going to be negative on the put side. So we are going to gain $52 every with all things being equal, every dollar the stock price moves down, we're going to gain $50. And our theta is going to eat away at this because all options have a shelf life, and our theta is going to be minus 10. Therefore, each day we're going to lose at least $10 just for holding on to this option. That has nothing, that's with all things being equal. That doesn't count and include if the stock price moves either with us or against us. So let's say we're going to purchase this put. We say, yes, Apple is going to go down. We got a $13 expected move in here by April monthlies. We're currently trading at 213. I think we can be under 205 by this expiration. So what we can do is, if we don't want to pay this much money for this option, that's too much capital for us to allocate in one stock, what have you. You don't like how this is kind of laid out with your max loss and your probability profit. You can actually spread this out, and we're actually going to use it's going to be called a bearish put spread, or a put debit spread, because we are going to be bearish and we're actually going to be purchasing this spread out, because we are going to be purchasing a higher strike put and we're going to be selling a lower strike put against that for cheaper money. So we're going to go ahead and we are going to sell this 205 strike right here. We're going to click sell. And as you can see, everything down here changes. Our probability of profit went up. Our delta is now at minus 20. Our theta went from 10 to 0 basically. But now our max profit is capped here down here at 623 with our max loss at 373. So we went from paying $8 and having an unlimited amount of max profit. We got some theta in here that we have to worry about. Our probability of profit is only at 38. Well, now we're selling this 205. Our probability of profit went up. We're almost at 50%, but we're not making that much on this. So we're actually purchasing this for $377. That's because they're taking the mid price here currently that this is trading for, and they're selling it against the mid price here that we sold this 205 for. All in all, that's going to give us a mid price of $377. So we're going to purchase this for $377. Now, why is our max profit here capped at 623? Well, we're going to take what the wings of this spread are, the 205 and the 215. That's a $10 differential, correct? So we're going to take that $10 and we're going to subtract what we purchased the spread for, 377, from that, and that's going to give us that 623. So that is how you get a max loss of 623. So you take the width of the spreads, $10 here, 205 minus 215, that's going to be $10, and then you subtract 373 from it, and that's how you get the 623. So if we expire above 205, which that's our underlying assumption, we think that Apple is going to go down below 205 by April 17th, then we're going to realize this max profit of 623. Now, Why is this area green right here? What does this mean? Does that mean we still make money up to here? Well, the answer is yes. So we actually can break even on this. So what you do is you take the purchase price for your option that you purchased it for, 377, and you're going to add it to that long strike. So on the call side, we added it here to these lower strikes. On the put side, you're going to add it to the higher strike, this long strike here, the 215, and then you're going to subtract it. So 215 minus 377, that's going to give us right around that 212 range. Really, it's about 211 and some change. That is going to be our midpoint or our break even price. And anything that if the stock stays anywhere below that break even point, then we're going to make at least 1 penny, right? That's exactly what that means. We're not going to lose any money at all. So that is the good news in here. So really what you're doing is you're allocating, you're saving money, overall risk profile, you're saving money. Now you can allocate capital in different things. You're not paying that much, but your risk profile, your risk to reward ratio is obviously adjusted where your max profits are now capped. Your probably a profit did increase and your delta decreased as well, but your theta also went in your favor overall because you do not want negative theta really, because each day it's going to eat at you unless you're selling something, right? Unless you have a credit spread or you're selling some sort of option. That's the only reason that you would want positive theta. If you're purchasing anything, you do not want positive theta because that's only working against you. So here you have basically theta of 0. Our delta obviously went down, but our probability of profit actually increased here. So this is a good tool to use if you still want to participate in that move, or your assumptions still stay strong with Apple pulling back by April 17th, because now you're not paying as much, but you're still participating in that underlying move, but your max profits and your gains are obviously capped. And you can move this, you can spread this out. This is only a $5 wide debit, or I'm sorry, $10 wide debit spread. You can actually move this down. We can go here to about $20 wide. And now you can see our max profit is at 1,400 here, but we're actually paying more. We're paying the 590. So maybe the 800 wasn't for us, but we can pay right around 5 or 6. Well, then we'll go ahead and we'll sell this 195 here. So now you have a $20 differential between your short and your long strikes. You're going to take 590 minus that. That's where you're going to get that 1410. Max profit's going to be at 1410 if Apple expires below 195. But really, our break-even price is going to be down here right around that $2. Let's see, we're trading at 215 right now, so it's gonna be right around that 210 area, right in here, a little bit below it actually. So all in all, it is a great tool to use these debit spreads to still participate in underlying moves. It's gonna help us as far as our probability of profit, so our chances of actually making money, and we're not going to lose all our money, right? So it's a good tool to use if we want to just kind of spread this out by 10, and then instead of averaging down when it goes against us, right? So we're purchasing this 215 for $8. Stock goes against us, we're at 220. Well, now this 215 is only worth $4. We're going to double down. We're going to average down. We're going to buy a 230 something. Well, really, you didn't really need to do that, because in the beginning, if we just would have had a debit spread, then we can easily double down and average down our total cost, because now we're only purchasing this for 377. So the stock goes against us at 220. Well, then we can come in here and purchase one of these naked, or I'm sorry, just one of these long puts. And that's going to take our average way down, because we don't have $800 allocated in that move that went against us. We only have 377. So that it's overall a great tool, but also you have to remember how to use these and what they represent, and how to work these in your favor with your underlying assumption. So all in all, that is how debit spreads work. All right, guys, if you like this video, make sure to check us out on all of our social media. We also have a Discord server if you're interested, and you can find all of our socials in the description below.